Hey everyone, and welcome back to another episode on the Financial Madness. My name is Kozan and I'm here to help you be better with your money. So in this episode we have a lot to discuss. I will be doing a step-by-step guide on how to invest in an index fund. We'll be using Vanguard as an example, as that is one that I use myself. But as part of this process, there's going to be a lot of terminology and financial jargon, which some of you may not know. But I'm likely to create a future video which goes into a bit more detail about what these financial jargons and terms mean. So stay tuned for that. So yeah, let's get on. So at the very beginning of my financial journey, my initial plan was to invest in specific companies by buying some of their shares or stocks, but purely based because that's the only thing that I knew on how to invest my money. But as I did more research, I came across these things called funds. Now there's two types of funds that we need to be aware of. There's the active fund and there's also a passive fund. Before we go into that, let's just go over what a fund actually is. A fund is a collection or a basket of stocks that are used to track a particular market. Now I'm going to go over what I mean by a market in a second, but I really want you to grasp the concept of what a fund is. And I'll use this using a simple basket analogy. An index fund is essentially a fruit basket. A fruit basket holds many fruits, and each fruit represents a company. I can choose to invest in one of the fruits, let's say an apple. But I can also invest in a basket which holds that apple, but it also holds an orange or a banana or a mango, etc., etc. So if I choose to invest in the apple, that's the same as me choosing to buy a particular share for a particular company. If I choose to invest in a basket, however, that's the same as me investing in a fund, because a fund holds many companies. It's important to note that with a fund, you only own a share of the basket and not the fruits themselves. So you will not become a shareholder of a company, so you won't become a shareholder of Apple. So you only own a unit or a share of the basket or fund itself. Now I hope that's made it clear, so let's go back to what an active fund actually is. An active fund, or what we call here in the UK a mutual fund, has someone called a fund manager responsible for looking after this fund. Now this fund pulls in money from all these investors, and this fund manager will choose which companies to invest in for this fund with the aim to beat the market. And when I say the market, I'm actually referring to a benchmarking tool. This benchmarking tool is used to measure how well or how badly a particular sector of the economy is doing. These benchmarking tools are known as indexes. One of the most common indexes you're likely to have heard across in the news is the S&P 500, which is made up of the top 500 companies in the United States of America. Here in the UK, we have something called the Ftse 100, which is the top 100 companies that are traded on the London Stock Exchange. Both of these are indexes. So when a fund manager says they're going to beat the market, they're essentially saying they're going to get a higher return in their funds compared to, say, the Ftse 100. So if the Ftse 100 is returning a rate of 6%, we expect the mutual fund to be returning at a higher rate than 6%, because its aim is to beat the market. A passive fund is slightly different, and this is where we're talking about index funds now. An index fund doesn't aim to beat the market, nor does it have any fund manager to manage the fund whatsoever. The aim of the index fund is to track or replicate the market itself. So again, if the Ftse 100 is returning a rate of 6%, we expect our index fund to be returning 6% as well. Vice versa, if the Ftse 100 has a bad term and loses 6%, our index fund should do the same. So it should now be clear on the difference between what an active fund and a passive fund is. An active fund is a mutual fund that has a fund manager who aims to beat the market. An index fund, a passive fund, which is an index fund, doesn't have a fund manager and its aim is to just track the market. One thing to note is that as there is no fund manager with an index funds tend to be a lot cheaper than their mutual fund counterpart, as mutual funds tend to have additional costs that cover the financial activities that the fund manager carries out on his day-to-day work. There's also significant evidence out there that suggests that active funds don't actually tend to beat the market on average. So you end up paying more for a service that returns you less. This is actually one of the reasons why index funds have grown in such popularity with beginner investors in recent years. One of the great things about index funds is that it's typically diverse in its characteristics. An index fund tends to hold many companies, so again, you're diverse in the amount of companies that you're investing in. But you can also be highly diverse in the sectors, so investing in technology or pharmaceuticals, or regions and areas around the world, so investing around America, China, the UK, parts of Europe, etc., etc. If I chose not to invest in an index fund, but instead choose to invest in a specific company, let's say Apple or Amazon, and they are currently performing quite badly, I stand to lose a fair bit of money. However, if I invested in an index fund that tracks the S&P 500, which Apple and Amazon are also a part of, and Amazon and Apple still do badly, the impact on my fund won't be so drastic, as my fund would also, if it's tracking the S&P 500 correctly, would have also invested in other companies as well. I would like to hope that these companies would help make up the difference that Amazon and Apple are putting into my portfolio. So an index fund is really good at minimizing risk where possible, as it is diversified in companies, sectors, and in areas and regions of the world. One more point just to quickly add on. Let's just say that Apple and Amazon are going through a really terrible time and they're on the verge of bankruptcy. Because of their new current financial state, they would likely to be dropped from the top 500 best companies in the United States of America. Therefore, they would be dropped from the S&P 500. And if your index fund is tracking the S&P 500, your index fund would also drop Amazon and Apple from your fund and invest in another two companies that are performing to the S&P 500 standard. So it's really good at diversification. So before I go straight into the Vanguard website, you'll also see the term ETF thrown around. ETF is an exchange traded fund. This is very much like an index fund, and sometimes they're actually confused as the same thing, but there is a specific difference. And that main difference is, for an index fund, you can only buy and sell an index fund once per day. But an ETF, which still tracks the index, can actually be traded whenever the stock market is open. But because you are buying and selling on a stock exchange, do expect higher trading fees to be included in the cost of the fund. ETFs tend to have a much broader selection of funds compared to an index fund. So if you are looking for a particular sector that you really want to invest in, an ETF might be the right way about going your investment. By the way, as a quick disclaimer, I'm not advising on any products. By the way, I'm using Vanguard as an example just because I am using that product myself, so I know it quite well. But do your own research. I'm not advising in any way. I'm just transferring knowledge from one to another. But yeah, I do really encourage you to use this as a guideline, but go off and do your own research as well. So I'm now on the Vanguard homepage. This is the homepage for the UK. I'll put a link in the description below for you to have access to. I know for America there is a slightly different page, so if you are watching from America, do check out that Vanguard page rather than this one. But from what I've seen, it's very similar, so whatever I'm showing here can be translated to whatever the Vanguard page is showing over there. So let's go straight into the full list of index funds that they have. So I'll click here, index and active funds. We don't care about active funds for the purpose of this video, so I'm going to uncheck active. You'll also see there's a section for ETFs. I'm going to keep it unchecked for this video, but if you are interested in ETFs, do select that for a more variety of funds. As you can see, the fund just went up to 51, but we're going to stick with these 29 just for the purpose of this video. Cool, so as of this date, Vanguard offers 29 index funds. And you can see it's split over two different types of products, equity and fixed income. So simply put, an equity fund would be a fund that buys and sells company stocks and shares, whereas a fixed income fund buys and sells government or even corporate debt. These are typically known as bonds. So for the purpose of this video, just be wary that a fixed income is typically low in risk, which often means a low return. Whereas equity, yes, you can have some in low risk, but you're sliding into the more high risk scale, and we'll go into that in more detail now. So I'll open up the 15 equity funds that are currently available on Vanguard. I'm going to toggle this tab to a more detailed view, and I'm going to just go through what these numbers or titles mean, so we're on the same page. Cool, as you can see here, under equity, we've got all these funds broken up into actually subsections. So we've got index funds based around in Europe, so we'll expect it buying and selling shares for just Europe specific companies. We've got global ones which are worldwide. We've got a UK specific one, so you can see we've got a Ftse 100 index. We've got one specific for Japan, Asia Pacific, USA, and emerging markets. So just taking one as an example, so I'll stick with the top one here. So this is the Ftse Developed Europe excluding UK Equity Index Fund. The ongoing charge is 0.12%, comparing that to the mutual fund average, which is around about 0.8, but you can find cheaper than that. I'm just giving you an average here. But just to give you a perception that the index fund is typically drastically lower when it comes to ongoing charges compared to a actively managed mutual fund. So the next column that we have is risk. Now this is measured on a scale of 1 to 7 with Vanguard, and Vanguard actually calculate this based on the volatility of the fund. So a highly volatile fund typically reaps higher rewards. A fund that is lower in volatility or a lot safer will reap lower returns. That's the general rule of thumb, but obviously performance from the past does not represent the future, so just be wary of that fact. So Vanguard have actually rated this fund on a level 6, so it's quite a risky fund compared to the others. The next column we have is the net asset value, or the NAV. This is also called the market value. So this is the price at which you can buy a particular unit of that fund. So this Ftse Developed Europe Index comes at £272.09 per unit. This is calculated by the value of the fund divided by how many units this fund has. You'll see on the next column we have a 1-day change. So compared to yesterday, the price has dropped down by 0.2%. On the right hand side here, we've got past performance as of the 31st of July 2020. So you can see it's broken down in years. So during the year to August 2015 to July 2016, the value of the fund had went up by 6.86% compared to the previous year. And in 2016 to 2017, the value of the fund went up by 23.94% compared to the previous year, and then 5.944%. Currently this year we're experiencing a dip. So this is one of the things that I tend to look for when I am investing in an index fund. Obviously an index that is constantly in the red should raise some questions. And obviously if a company is quite often in the green, it could be a good prospect for an investment for us. I've said this before and I'll say it again, past performance does not guarantee future performance, but it is useful as a gauge. So let's go into the Ftse Index in a bit more detail. As you can see, the top 4 blocks here, we can see the price that we saw on the front screen. You can see it actually changed, gone down in value by 54p, which is the same as 0.2%. It's invested in 485 stocks, which is actually quite medium for an index fund. Quite large index funds tend to be in the thousands. The ongoing charge is 0.12, and obviously 6 out of 7 for the risk value. One of the key things to look at the objective, so this is really the mission statement of the index fund, so it should be telling you what its goal is. So here it immediately says this fund is a passive fund. It seeks to track the performance of the Ftse Developed Europe excluding UK index, and the index is comprised of large to mid-sized company shares in developed markets in Europe excluding the UK. So immediately I know it's looking at developed markets in the UK, and it's looking at the large to medium companies excluding the UK. Cool, and then we'll look at the past performance. This is again a diagram representation of the past performance we saw on the main homepage. But one of the good things about this bar chart is actually it shows you the comparison between the index fund versus the index on how it actually performs. So here in the grey is the NAV, so that's representing our index fund, and the one in this sort of turquoise green is the actual index itself. So in the year 2015-2016, the index fund grew by 6.86%, as we saw in the last page, and the benchmark did the same. So that's good to see that it's following it quite well, which is a good indication that the fund is tracking the index as it should be. We'll look at the next year, it grew by 23.94, and the benchmark grew a little bit more, so 24.03. So obviously it's not perfect, but it's pretty close. And you can see from the rest of the following years, it's doing pretty much the same as well. So this kind of gives me the confidence that this index fund is actually doing a good job of tracking the particular benchmark, which is the Ftse Developed Europe Index. And if we scroll down here, you can see past performance on a lump sum. This just gives you an indication of if you put a lump sum of £10,000 in July 2015, that money would be equal to £14,168.10 at this current date of July 2020. So let's go to price and performance. Here gives us an indication of the prices, which we've already gone over. This gives a visual representation over the current months. If we do over 18 months, you can see it's quite volatile in certain years. One of the key things that you really need to understand when choosing an index fund is your attitude towards risk. Would you be comfortable with investing in a fund that is highly volatile but produces higher returns? Or would you sleep better at night knowing that your fund is in a low risk account but is not generating as much return as if you went to a higher risk investment? So let's go into some of the other key informations here. Portfolio data, this kind of gives you a comparison of the fund to the benchmark. I'm not going to go into too much detail here, but here you can see sort of the sector or region exposure that this fund has. You can see that this is 98.3% Europe with a small percentage in other emerging market specific. Market allocation, we can go into a bit further detail. So obviously a large portion of the companies that we're investing in is in France, Switzerland, Germany, Netherlands. We've also got the sector breakdown. So they're heavily invested in consumer goods, healthcare, financials, industrials. They're quite evenly spread. So if we scroll down, it actually breaks down the list of companies that are invested. I think it's showing us a top 10 for now, but we can scroll down further if we want to look at all the 482 companies it's invested in. But you can see sort of 5% is invested in Nestle, 3% in Roche, SAP 2.64, etc., etc. So if you're quite keen in investing in a specific company as well, be sure to find funds that are quite heavily invested in that company as well. Cool, and then let's just go straight to cost and minimums. As you can see, this shows you the charge for the fund. So that's 0.122%. And then to open this account, you can create a £500 one-off payment, or you can do a monthly direct debit of £100 into this fund. One thing to be wary of is that your index fund does actually earn dividends, but you'll notice here that our index fund actually says the word accumulation at the end of it. So if you see the word accumulation, that means any dividends that fund earns is automatically reinvested in your fund, and it's completely automatic. Personally myself, because I chose Vanguard to invest for my long-term goals, I stuck it on accumulation. I'll put a link for my previous videos on the compound interest and the Latte factor, where I demonstrate how even small amounts of money can go a long way into your investment growth with just the use of compound interest. But if you do wish to decide to claim that dividends, you can switch here to an income share class, and you can see the word has now changed to income. And if we go to distribution here, you can see more information about income that was distributed over the last several years. So hopefully you now have a good basis of understanding how to decide on which index fund you would like to open. I'm going to quickly show you now how to open up an account. So I'm just going to click here, open account, and we'll start my application. So you're given a bunch of options. So you've got the Vanguard Stocks and Shares, the Vanguard Junior ISA, Vanguard General Account, and Vanguard Pensions. I also did a video on ISA accounts, so be sure to check out that video if you don't know what a Stocks and Shares ISA is or a Junior ISA is. But for most cases, it is generally more beneficial to invest in a Stocks and Shares ISA because of the tax benefits that you get. So I would always encourage to open your Stocks and Shares within the ISA wrapper, but do check out my video if you want a bit more information on how that works. So we're going to open up an account, and then yep, you'll just read the policy. I'll click next, proceed. And then this is the point where it gets you to choose the funds that we're interested in. It automatically defaults to an accumulation fund, but if you do want to see the income funds, just simply click here, and then you'll only see, you'll see both the accumulation and index funds listed below. I'll complete the order. So an investment fund, so we were looking at the Ftse Developed 100, so I can do a regular payment of 100 or a single payment of 500. That's the absolute minimum. So I'll just do 100 here, and we'll go next. So on this next page, it's just a details page, which I'm not going to go through. It's your standard form to open up an account. And then essentially when you click next, the application will be created. There'll be an order form that you'll get to show that you've purchased the £100 worth of units for that particular fund. And that usually takes about a couple of working days for that to go through. Cool, so that's how you open up an account. And then I'll show you what the account kind of looks like. So I'll log in to my personal account. I'm going to block out all the personal information. So as you can see, I've invested in my ISA account. And if I want to see the list of investments, I just go to investments. So I've invested in these types of funds. And if I show you the rate of return, and yeah, as you can see, since my account is opened, I've earned a rate of return of 25.25% as of the 22nd of August. So that's it for this week's episode. I hope you found that really useful. We covered a lot of stuff here, so if there's anything that I've missed, please let me know in the comment section down below. And as always, if you like what you saw, I would really appreciate a thumbs up. It really helps out my channel. And if you want to keep up to date with my upcoming videos, be sure to hit that subscribe button as well. See you later. Bye.